there, traders. Todd here. Welcome to the Wednesday live stream. I am Todd Gordon, founder of tradinganalysis.com, Inside Edge Capital Management, and hope you guys are well. Almost hit our 8:45 time, but a lot of pre-show prep going on here with the team. I'll bring them on in just a second. But again, thanks for joining us. Throw your questions, comments, insults in there, and we'll be sure to address all of them. So more drama unfolding here, this time overseas. Credit Suisse trading, last I checked, at $1.87. The Saudis gave them the Heisman on a request for additional funding. This financial contagion continues. Indexes, we'll jump into them, mostly range bound, pressing lower levels. I've been outwardly bullish on this market, but I'm a trader and a portfolio manager, not an analyst and a long-term forecaster. So we have, long positions on, but we have hedges. I'll show you some of those hedges. We did short some financials with our clients yesterday, and we'll get into that a little bit. So it's a two-way busy market. Macro forces very much at work. Fed funds all over the place every day. The terminal Fed funds rate is moving by 25 to 50 basis points, man. It is full speed. Plus, I was at the hospital last night with one of my twins who finally broke his wrist, catching up to his twin brother who's broken his wrist twice. So no shortage of drama. Good morning, Alex and Terry. How you guys doing? Oh, hold on.
The young one.
There you go. Sorry, go ahead, boys.
How is the young one?
He's fine. He's pissed off that he can't go to a ski race this weekend, and his brother's already kind of leaning into him a little bit.
Yeah, that's a lot of hard work and practice they put in, and then you get right there to the competition and miss out on it because of that. So,
it's all right.
Oh well. Kids.
I told him when I was a younger growing up ski racer, I broke mine. Actually, the doctor fit I cut the top off my ski pole and put it in like this. I broke my wrist so they could fit the ski pole in. I duct taped it every time I want to go skiing. I got through the season, but kids aren't tough anymore. So, all right, let's jump in. Boy, what a session, guys. Opening comments before we jump in. What do you think?
Well, I mean, it's been a rock and roll event. With all the recent happenings in the financials, a lot of people, I think, even forgot what happened with the rest of the market last week. So I'll bring them up to speed on that.
Yeah. There's certainly a tale of 2, 3, 4, 5 different cities going on right now in this market. So let's jump in. I don't want to waste your time. We got a busy day with the members here. As we, after this live stream, this Wednesday live stream, we go into Elliott Wave Wednesday with our members. So we're going to get it going, get you up to speed from our point of view, and just looking at where we are here on the open. Of course, we've got S&P futures that are down 1.95%. This 38.77 level or 38.50 has been critical since the end of last week. So here we are again. NASDAQ down 1.5. The small caps, guys, down 3. The outperformance that we've been seeing in small caps, in mid caps, Terry, trading analysis, I think we've been very much ahead of that. We've been positioning it and trading it and taking advantage. Boy, all of a sudden, as the regional banks got hit, the constructive base that small cap Russell was building just got smoked. Just smoked.
Yeah, they peeled off.
Peeled off hard.
Like a banshee.
Yeah, it's been wild. And so again, it's all about rates. It's all about contagion. We have a CPI that came out exactly as expected, with the exception of month over month on the core coming in 1/10 over, driven by food and shelter, which everyone, it was largely as expected, and the market acted really, really, really well. So we're seeing a rotation into growth. Terry will get you caught up to speed in terms of where we are in the indexes, guys. It's this dynamic that growth, large cap growth, is now trying to rotate in. It's stabilizing, heading up, as value was already rotating out. Now we're getting small cap and medium cap value from the banks and some real estate. We're doing a lot of deep dive in the real estate sector. They have rotated out. So you have no real large cap leadership driving these indexes. So we're very sideways. So from an Elliott Wave point of view, we'll jump in there and listen, there's multiple possibilities right now. I'm not going to sit here and tell you, this is the wave count. If you're out there saying it publicly, if you're an influencer or you're an authority in this and you're saying this is the way it is, you're wrong. You don't know. You have to act with integrity. Our job is not to forecast, at least our job at Trade Analysis is not to tell you what's going to happen in 6 months. It's to manage our capital in the current situation efficiently and as a fiduciary, and being professionally honest and saying there's multiple possibilities as to where this index goes. And we're looking for large cap leadership because that's the only thing that's going to make the indexes lead. Right? So don't get out there and say, you're wrong, this is the wave count. I wouldn't say that to anyone. I encourage debate and look at multiple people's wave counts. And as long as it obeys the few rules that Elliott Wave has, as long as it observes the guidelines, I'll entertain it. I'll look into it. All right. So as of now, this is kind of this is our primary, this 3850 was massive. I don't love it. It broke below 3850 on the 11th. We have this as a contracting diagonal, which the rule, according to my good friend, and I'm saying that like I'm a show business good friend. I do consider him a friend. Bob Prechter, I really, really like him. We worked together for a while. He put the rules out in R and Elliott's work and saying that a contracting diagonal, wave 3 should be the shortest, wave 1 longest, wave 3 the middle, wave 5 the shortest. On the same light, wave 4 should be shorter than 2. However, that 3850, which was the defining length of the percent distance traveled in wave 2, 8.2%, was broken briefly, but then we got back above it. So is it still valid? We can debate it. So that's 100% right there. This level that's kind of hidden, 3851, is the 8.2% projection of wave 2. It's also the 78.6% of the December to February 2nd rally. Key level. And as we get down into a 60-minute, you could see the interaction around 3850. I mean, I was even day trading some SPX call options with clients against 3850. We traded it again in NDX yesterday. We're just holding. So as we trade pre-market here, S&P futures are where? We are at 3873, closed 39.19 in the cash, 3873. Now, if we start to head back down towards 3850 again, I'm all but prepared to get rid of this diagonal count and entertain one of two triangle situations. Triangle being that we're in this and it's a B wave and we drop down 3200, or trading analysis count that I don't think anyone else out there is looking at is potentially, if we break 3850, we could just skid into the summer via a Y wave triangle. And I know there's a lot of fib in here that's messing this up, but this is another possibility. I mean, we could jump on down to 3750, bounce up in D, E, and then this whole thing was a W, X, Y triangle. And neither the Bulls nor the Bears will win. And we could just go sideways. And I think that would piss off the most amount of people. And that's really what the market is designed to do. Sorry to be so crude, but the market's job is to frustrate as many people or push people to the brink of their risk tolerance out of the position they want to be in before the market makes the move. And for me, guys, this makes the most sense. But again, I've only been doing this 20 years, trading professionally. I am so content to say it's a coin flip in the indexes right now. And I'm open to anything that you have. And I think that's the mindset you need to be in as a trader and an investor and a portfolio manager who has money in the market right now. Guys, what do you think?
Yeah. Market certainly is also known as the great humiliator. That's Ken Fisher's favorite term for it.
Yep.
And exactly as what you're saying. They just as soon as you think you know which direction the market's heading, it's going to give you that head fake move. And so that's what you really got to watch out for. So, what Todd's saying about why we're carrying the multiple wave counts is because when you get into this uncertainty point in the market, this is the time where you need to be cautious with any trading that you're doing. Doesn't mean you can't trade, but you're going to have to heighten your awareness of the possibilities of going the opposite direction that you're planning. Now, when the market gets in a good stable trend, you're going to see we're going to get a lot of conviction on a single direction in the market, and then the market's got a good trend, and then we push heavily when that happens. But right now, it's choppy waters, dangerous waters. So, trade carefully.
And that's well said. And that's why I love Elliott is, we're starting to back into the idea that it could be a triangle. And if you can identify a triangle in real time, that's good, because a triangle by definition is supposed to chop up the bulls and bears, and it'll give you the context, framework, duration, boundaries, price boundaries, to expect continued consolidation where you don't want to get too crazy trying to play breakout. So all that being said, look, I have longer term positions. We have longs on the wealth management side. We have it. We're building a good stock swing desk on the research side. So I'll show you one hedge that I do have on. We have on with clients is in the SPX, and I made mention of it in Twitter, and we put it on a couple days ago. What do we put it on? The 9th. Actually, wow, it's already been almost a week coming up here. So we put it on in the 9th. The market, we centered it around a 38.50 butterfly. Okay, so the 9th in the market was right here. So we're at 39.90, thinking we get down to 38.50. Well, we're there. So we have sort of it was a moderately bearish hedge to get down to 38.50, looking for a 100-point drop in the S&P. Expires March 31st. We have 2 weeks to go. We have pretty good theta building up here on this, guy. As we get closer, we need to stay somewhere in this zone. Now, if the triangle starts to break down, because again, we're looking at, I'd really like this first zone of fib support to hold 38.52 to 27. Obviously, we're going to go back and retest that this morning on opening credit squeeze issues. And then if we start to push lower, I'm going to have to get out. Okay, I'll get out.
We're about 38.30 right now, I think. So that's right in the middle of your triangle. That's perfect.
I got 38.76 in the futures. Okay. So that's that. So from there, I mean, we are looking at continued weakness in the financials. I do want to talk about rates quick, and then I'm going to turn it over to the guys here. But we have some serious concerns in financials, and we also put a hedge on in Bank of America yesterday. And we're seeing weakness in large money center banks, specifically Bank of America relative to J.P. Morgan, Citibank, U.S. Bancorp, Wells Fargo. Bank of America, it has been underperforming large banks. So I'll show you Bank of America in 1 sec. I'll show you the option trade we're in. But XLF is at a critical position right here. Alex, you're working this red count in the financials ETF, correct?
Yeah, that's the one of the option. The second option is we go down and wave C prolongs a bit more. So this is A up in B and down in C, which will give us a little bit more downside.
Yeah, I'm starting to think, and the rule of thumb that we use is if you don't hold the 786 retracement, and how do you get 786? Very few people know this. You just take the square root of your golden ratio. Take 0.618, you square root it, and you get 0.786. So this is the retracement of last resort. If you don't hold that, typically you're going down. This is getting geeky, but typically you get down to the square root of 1.618, which is 1272, which I got to adjust more.
I have a question for you that maybe some of our clients would also want to know.
Sure.
So inside your wave 2, you've got an ABC, and the B wave is higher than the wave 1.
Yep.
When you do your fib retracement, do you go from the origin to where you have 1, or do you go to is that called the orthodox high? Or
this is the orthodox high. Yeah, exactly. And yep, that's a great question. And few people understand that you don't do a retracement if this is your 5 waves up in one, which I would argue that it is. And then I would say you can clearly see that this is a 3-wave move. So that's going to be B. So what you do is you take a retracement. You want to know how much wave 1 is retraced. I don't care. This from A to B, this is not part of wave 1. This is part of a expanded flat in wave 2. So you want a retracement is not studying the end of wave 2, which would be, the high point in wave 2. It's the studying what percent rally in wave 1 would be retraced in wave 2. So this wouldn't be wave 1. That's wave 1. I hope that answers that question, but it's a good question. So you want to go from here.
Yeah. In some cases, that B wave gets a lot higher than where we have the 1, and it makes a lot more difference. Right now, it's about 100%, so you really won't see that much on this example. But yeah, you pay attention to that if you guys are using your manual fibs.
It's so true, and this is something I think the Elliott Wave community for probably coming up on 100 years. There's no guidance as to how far, and there's a lot of this going on in the indexes right now, how far a B wave can go above the A wave. And there's no guidance out there. And that makes it incredibly difficult. Is it 1618? Is it 2? Is it 2618? What is the boundary? And our friends at Elliott Wave International and other people whose work I very much respect in the Elliott Wave world, there's really no, why can't I do extensions today? I'm not doing very well with these. There's really no guideline out there for that. So I hope that makes sense. And that's something we can address later. But anyways, so good question. So if we don't hold 786, and Terry's question is very, very valid, his observation, it's 786 of this 23.187, 23.3187 move from October down. If we don't hold 3095 XLF, is probably looking at this situation. Now, Bank of America, as I said, I don't want to mess around with the regionals too much. A little bit of volatility, obviously, but if you look at Bank on the weekly, it's a clean wave count. It looks like we've broken 29.5 support, now resistance, and it looks like we may have a 4th wave that squares up against the 2010 to 11 drop in Bank of America. So as we get to the daily, that's where it is here. And let me get on 60-minute. This has been the price action around that 29.67 level. A lot of gaps, a lot of moving around. And it looks like we're going to be down at 27.69 on the open. And again, we're doing a lot of option hedges in here to take advantage of this kind of stuff. So here is the fly we put on yesterday with clients centered around a 20, where's my strike? 25, sorry, it's a 28, 26, 25 broken wing butterfly. Okay, so we're trying to get down to the 26 level in Bank of America here for expiration as we trade in 27.65 pre-market. So, all right, let's get off of that real quick, go to the NASDAQ, and then I want to just do quick on rates and turn it over to the guys. Okay, so in terms of the NASDAQ real quick, NASDAQ's going to be a cleaner wave count than the S&P. Okay, so that was all an S&P question. If we look at where we are in the daily NASDAQ, I think this is a much cleaner diagonal. Okay, so coming off the October lows, it's 1, it's 2, it's 3. All the rotation, and Terry's going to show us that we're seeing here, there's been a ton of rotation into growth with this significant move down in rates. If you guys have been watching on the YouTube channel, I've been just begging for the 10-year rate to drop below 4%. Well, we got it. And as I said, be careful what you wish for. It went down for the wrong reasons, but it is starting to get NASDAQ a little bit of a bid here, and growth stocks a bid, which is good. So getting down shorter term, NASDAQ's obviously down here this morning, and we'll see how this is going to hold up, this wave count. We're looking pretty short term here. I'm looking at a possible 3rd wave situation. We closed at 12,199 yesterday pre-market. we are trading, where's my futures? Somebody throw it at me if you have it. I have so many windows open. There we go. 12,140, 12,140. So a little pullback would be fine, but we are potentially in a third wave situation. And if we start to break back down, we're going to have to extend this wave too, but continuing to remain bullish for now. Okay. Let's talk about rates. Now, the big move, again, 10-year moving away from 3.5, and that's all I wanted was 3.5. And unfortunately, holding 4.8 to 4.17, we got it, and yields gapped down for 3 days, 2 days in a row. So just massive gaps in the charts. Yields are all over the place. We're looking for support a little bit lower. At this point, we don't want yields to go any lower. Now, there's been a lot of movement in interest rates, and you guys, as stock traders and even investors and stock traders, you have to understand the impact on what's going on with rates. Now, there's been huge movements. Okay, get out of there, video. So we're looking now at the 10-2 spread. This is yield curve inversion. So this goes all the way back. Obviously, inverse 10-2 curve puts us on recessionary watch. We got down to as much as 107 basis points of inversion. But with the big move that we saw after CPI, Alex, if you're, okay, that's all right. After CPI, we cut the inversion in half. So we went from 1.07 to as low as 0.48 basis points of inversion. Right now, I'm showing 0.55 of inversion. So that's a step in the right direction. And again, that's part of the reason you're seeing a move up in growth. Now, I constructed a real yield curve. This is the best that I could find. I couldn't find an indexed inflation 10-2, and I couldn't find an indexed inflation 10-year 3-month to look at the real yield curve. So on St. Louis Fred database, I constructed a indexed inflation 20-year U.S. Treasury and subtracted from a 5-year Treasury. So it's a 25-year spread. Not perfect, but pretty good. And you can clearly see overlaid in the S&P, there's correlation there. And what's good here is you have a higher low of inversion of the 25 real yield curve chart. And if we can somehow sneak back above, that's going to be very, very constructive. Okay, so watch that guy. The other thing that I wanted to show is it's interesting. Where is my 10-3? Nah, it's not going to work. That's okay. Let me pull this over. Okay. The other thing that I find interesting is the spread between the 3-month, which is reflecting where the Fed funds is going, and 2-year. For the last 8 months, I've heard people say it's the same thing. It's not the same thing. Okay, the 2-year tries to influence where the Fed is going to set short-term interest rates, which again, that dictates everything in this market. Aside from contagion, it's reacting to inflation, but it dictates everything. You can see that clearly there's movement. This is the 2-year minus the 3-month spread. Well, we've gotten to some very, very oversold levels here. And what I find interesting, and Alex, are you paying attention? I want you to react to this. Okay. There's been pretty significant, come on, 190. There's been pretty significant times where the spread between the 2-year Treasury and the 3-month are at levels they're at. Now, what's interesting is almost every time we get such a negative divergence, a quarter basis point, whatever, usually you get stock market volatility. You get it here, and these gray areas are recession. You get it obviously here in 2000, and you got it here in COVID. Well, what is the difference? Those of you who are paying attention, what is the difference between this situation and 2020, 2006, 2000? Not the case here in 95. Stock market went a rally, but we didn't quite get down to negative 2-year minus 3-month rates. The difference is every time we've seen a recession with the stock market sell-off with 2-year, 3-month spread negative, It's the 2-year pulling the Fed funds higher. 2-year trying to convince the Fed to raise rates. So purple is your 2-year, orange is your 3-month. Purple's trying to pull orange higher, Fed raising rates, stock market sells off. Right here, purple, 2-year pulling 3-month Fed funds higher, trying to get the Fed to raise rates, stock market sells off. Same thing here, purple pulling it higher, and then in fact, 2-year started to reflect in this particular case. 2-year started to drop quicker than the Fed was cutting rates, and we cut into GFC. And again, right now, what are we having? Why is there a 1/4 point spread between the two? Because the 2-year is dropping faster than where Fed funds is. So that's creating this inversion. So everything that we're watching, if you guys aren't watching this Fed funds site, watching the dramatics play out here in terms of where the Fed's going to stop raising rates, this thing is all over the place. All over the place. A week ago, there was no chance of a pause in March. Yesterday, it was a 30% chance. Now it's slightly better than even money that the Fed does nothing next week. And the other thing is not only that, but we went to 5.75 terminal Fed funds with no rate cuts when I was on vacation 2 weeks ago. Now, I mean, they're back to pricing in rate cuts. In September, they're giving us only a 25% chance we'll be above 4%. This market is all over the place. And that ties in exactly to what I was saying in terms of trying to make sense of the indexes right now. They can't get heads or tails right now because the Fed is just all over the place where they're pricing terminal Fed funds and what they're going to do in the back half of the year. Okay, so I'm kind of settling into this massive indecision level in the markets. Okay, we are looking at stocks that are not correlated to the market. There's good trades we're looking at. We do have obviously S&P hedges on. We put Bank of America short on. That's going to perform well, obviously, in the open. But we're going in eyes wide open, guys. I'm going to turn it back to you. Sorry to take so much time, but I think that's I think it's important. I mean, some of the member communications we've had, guys. I mean, holy crap, are they intense, right? And long.
Yeah, it's certainly the volatility spike. You know, we got down in like 18, 19 on the VIX, and then the VIX shot up to 35, and I think it's pulling back a little bit right now. So, you know, rapid change in market conditions. You know, the Fed's has mostly been relying on lagging data, waiting for the data to see what's happening, and there really hasn't been any major change up until we just saw what happened here with this Silicon Valley Bank crisis.
Yep.
So that I think was the monkey wrench that got thrown in here, and it's really changed the Fed's outlook. Who in their right mind at the Fed would raise a 50 basis point hike in the middle of trying to rectify this type of financial meltdown? So
yeah, absolutely. And then Elliott Wave Cafe says, sorry, my bike's over here. Hey, Todd, good to see you guys. How about a flattened 2? Is that Elliott Wave Cafe over on the trade, actually on my YouTube channel? Are you talking about daily S&P, the current decline from Feb top being a C wave? If this is what you're talking about, Elliott Wave Cafe, I 100% agree with you. And if this is the count, tell me if you're still there over in the trade analysis channel. If this is what you're talking about, I think it's anything's possible. And I think that would torture and twist the minds of the most market participants possible. But yeah, you could count this as 5 up. I mean, there's no overlap between 4 and 2. You go up in 5, you do ABC for a flat down in A, another 3-wave move up in B. Terry's point about where would you measure the retracement off of this? It's the net percent distance traveled in 1 where you study. So the rally in wave 1, if this is correct, was 17.45%. And then you do a retracement from the wave 1 high, not acknowledging the orthodox. B goes to a new high, but it does so in 3 waves. And if you look at where we are, the 38.56, that level that I talked about, 38.50, that is a 38% retracement. which is crazy. I mean, that's a shallow wave 2 retracement. Banking crisis, if this is accurate, the S&P did a 38% retracement. I mean, that's typically you get down to a 50 or 61%. That's indicative of a lot of underlying strength, and the S&P is not even where the strength is. It's in the NASDAQ. So, yeah, I totally agree with you saying I think QQQ SPY ratio is a big tell. Dude, look at consumer discretionary staples. Look at technology and utilities. Look at XLK into XLP. Look at XLY and XLP. Look at growth and value. Terry's going to show us. There's so many reasons, and again, as long I think this has scared the Feds. I believe this has scared the Fed that perhaps interest rates have gone up too fast, too quick, too fast. Now we have leveraged regional banks exposed to VC and tech and mismanaging their bond portfolios that are starting to fail. I just don't see how interest rates go back above 4% on the 10-year and we go back into 5.5, 5.75. I mean, that inflation report it could have been a little weaker, but I don't know. I just think there's been a sentiment change in rates on the short end and long end of the curve, and that in the growth seekers are starting to sniff that out. So let's turn it over to Terry. I've talked way too much, but Terry, why don't you set it up, and I'll bring you in here.
Yeah, the end of the interest rate hikes has got to be good news for the growth stocks, right? I mean, that's their pain comes with high interest rates, and that's what we want to see. Hello, guys. I'm Terry Long at Trading Analysis. We're going to have to zoom this thing out here. Hang on a second. I forget that this new tool we're using kind of
sorry for that.
This thing in.
Sorry for that, Luke.
There we go. We'll get that. I'll bring that in and over here. Let's start off with last week. The indexes fell really hard last week in a broad-based sell-off, and they did dip below their 200-day moving averages just briefly. For the week, the S&P netted a 4.5% loss. The tech-heavy index fell 3.75%, but it did fare better than the S&P. Again, that's that outperformance, right, that we talk about all the time. Now, the worst performance obviously came here in this financial sector. These are the individual sectors, so all 11 sectors. It was a broad-based decline, and again, all the focus has been simply on what's happening in financials, and everybody's kind of forgotten about what happened here with these other sectors. So there was a major push lower, but you do have you have several sectors that actually outperformed the S&P. S&P's this purple one right here, and so anything to the left there actually held up. Let's fast forward to this week a little bit. If I bring that over here, we'll get that centered. I want you to see this is 2 days worth of trading, Monday and Tuesday. Market about to open here in a few minutes, but we've got utilities holding up. We got the technology sector actually still net positive for the week. Yesterday's close, the S&P actually rallied back up off of this purge down that happened on Friday. We're actually back up 1.53% before pre-market. Excuse me, got an itchy nose. Index is up double. This up 3.12%. So if we're giving back 1.5% or something here at the open, we're still net positive for the week here with the S&P. The other thing I want to show you, there's a lot of stocks, financial stocks in those small caps, and we did see the IWM give back a lot of its recent gains. It was down 8% last week. I don't normally cover that, but I thought it was noteworthy. So far, we've got a big rebound happening again this week with all the different sectors that we chase moving back to the upside. Last week, this was all red. Looky here, I've got two different time frames where we use our rotations, and this is going to be your large cap growth and your large cap value. This is the same story we've been telling you. We've got over here on the daily rotation, each one of these little line segments representing 1 day of price action. Look here, we've got the growth back up in the leading quadrant and pushing to the right. Whenever you see these vectors pushing to the right, that means you're gaining relative strength and momentum versus the benchmark. And In this case, the benchmark is the S&P. So in both of these short and longer term time frames, growth stocks are outperforming the value trade. So the value trade, large cap value has been pushing lower, mid cap value has been pushing lower. And a week or two ago, we did tell you about, at that time, the small cap value actually was still pushing higher along with all the three growth trades. So we did see that major shift finally happen in the small cap value. And I think that's because there are a lot of the financial stocks in that small cap. I think if we were to dig into there, is it really many of the other sectors in that small cap? It might mostly be due to that financial trade. The sector leader scoreboard. Look who is now in number one position here. I may have to reduce my font size just a little bit there. Let's see, get that over there, down a little bit, over, I'll move that over. Okay, you can see the numbers. These things are sorted in order of relative strength ratio. Communication sector is now the highest relative strength amongst all 11 sectors.
Isn't that amazing?
The technology sector, whoa, if you were sleeping over the last couple of weeks, you missed the fact that the technology sector just rapidly advanced up here into the leading quadrant. And it's just about to surpass the materials and the industrial sectors, which we aren't giving up on just yet, because actually, even though we've got a momentum fade and a little bit of relative strength give back, the change that's happening here in the XLI and the XLB has been happening at a much slower pace than some of these other value sectors, such as healthcare and staples. If I bring this time frame back here, just back into the end of January, you can see where all these value sectors started pushing lower. And collectively, we saw an acceleration to the downside in staples, healthcare, and energies fading out also. But there, while financials actually started that re-acceleration to the downside just last week, we still got materials and industrials here. Now, we get a bottom, we get a turn, and we find our support here in the S&P and start to move back higher. I still think there's opportunistic trades in these two value sectors. We're going to be watching for that. Right now, Todd's got a line on short trades happening here in financials and possibly some of these other sectors. What he was talking about before, look at consumer discretionary, which is our third growth sector. It's also rapidly approaching a push, not quite there yet, into the leading quadrant, but it is pushed high up here into this. This is actually, excuse me, let me get a drink. This is actually the cap-weighted sector, right? And it's heavily influenced by Tesla and Amazon. Even though we've seen most of the consumer discretionary in the equal weight, we've already seen them. We've been talking about how they've been over here in the leading quadrant. We are finally getting the tick up higher here in Tesla and Amazon. We could be seeing a resurgence of the large cap growth trades back into the league. But, compare this move in the XLY to the move here in the utility sector, right? I mean, they're polar opposite moves, right? So as we've seen the XLY advance, we've seen the XLU and the XLP and the XLV, all of these retrace, and they are back down into the lagging quadrants right now. So a lot of opportunities are out there, but you've got to be following along and finding those opportunities. We're constantly looking for where the opportunity lies, where the stocks are pushing higher and outperforming the S&P. And yes, just simply because you see these vectors moving higher does not necessarily mean price is going higher. That depends on what the overall market is. These relative rotations are comparing yourself against the S&P. Okay, the benchmark that I use here is the S&P. So that's why we want to be watching that macro perspective. Todd, you can bring us back in now. And
Okay.
we want to be hanging on to where the indexes are going to make their major shift, but you've got to know then you know where to find that opportunity, and that's what we're all about.
You got to know when to hold them. Alex, get ready. We are watching one setup that I'm going to be watching here in the open is going to be healthcare. You had made mention, Terry, that XLV, which is that Thinkorswim opening bell right in my ears. XLV rotating out, with the overall growth and value, XLV right there.
Yeah, even on this
As
monthly chart, it's you can see it's losing its momentum on the
yeah,
monthly time frame,
yeah,
and then so we compare these multiple time frames to get the bigger perspective as to what's shifting in and out. We know traders. Some of you guys are longer term traders. Some of you guys are shorter term traders. So
yep. So healthcare on the weeklies, Terry was just saying, I mean, the value trade's just getting smoked. I mean, look at energy. We had a trade on XLE, sort of a slightly bearish butterfly, took it off because energy is moving too much to the downside. So energy heading in the wrong direction, healthcare, staples, utilities, what's heading in the right direction? This is just so important. Consumer discretionary, tech, and communications, and now large caps even starting to come online
and we
here.
didn't
So
talk too much about the real estate sector.
that's such a
And if you
deep
go back to that
conversation.
weekly,
You know,
yeah,
it's
yeah.
it's just too. I think it's too much for the scope of this. But you're right. Watching mRNA, a pretty good little wave for resistance zone here as healthcare is rotating out. We're watching. There's some strong names in there like Exact Sciences and Dexcom. There's a few decent healthcare out there, but kind of had my eye on this one into zone in mRNA. So let's turn it over to Alex. Get a macro perspective. Alex, you are up, sir.
Okay, guys. So let's
I'll
look
turn
what's
Alex
going
up.
on in
Can't hear
Europe.
him.
Yep. Gotcha. Go ahead, Alex.
Okay, so let's shift a little bit from US. Let's look what's going on in Europe. So this is the chart of the 10-year Bund. Tomorrow is the ECB meeting, which is about to raise rates from 2.5 to 3% so 50 basis points. In this situation, let's see if that will happen. So this is the 10-year Bund, and this is the monthly chart. What I found interesting, you will see that the yields are dropping from 1980s, and then we had this impulsive wave structure on the upside. And look at the monthly RSI. So this is amazing. We are almost at the highest level on these highs. So I guess we're going to revisit very soon these lower levels. I don't think it's going to happen immediately, but what you see here is a clear break, technical break of this pretty sizable channel from 1980s in somewhat impulsive wave structure. So I think we're going to keep circling around, maybe a little bit more higher, and then we're going to see a sizable retracement down, which is our general thesis that we're going to have a year or two of a real pause in rates moving up. And I think the rates are going to move either to be stable or a touch lower in 2023-24, even beginning of 25. So what is also interesting, this is the 3 months Euribor, 1 month, 3 months, and 6 months. This was trading last week around 4.2. So even 2 days ago, when we looked this on a macro Monday that we have for our members, this was close to 4%. This morning we dropped to 375 until October 2023. So this 3 durations dropping each day down for 25 basis points, which is very interesting. But you see the steepness of how these futures are looking lower to 2026. So somewhat in beginning of 2024, they took a deep dive towards 2.5%, and then kind of equalizes in a more stable manner. So This keeps dropping. I don't think ECB will raise rates, so that will be a big decision tomorrow. In this situation, they may be going to hike 25 basis points, which will make dollar rally, which is our next subject. So dollar is, I still think, in a corrective pullback, which will have back and forth. I think we're going to spend a bit more time until the situation clears out. I'm looking this for WXY. The question of which pattern is actually happening here is still unclear, but I think we're gonna eventually go higher up to some decent retracement levels. But look, from higher levels, we have clear 5 waves down, and then we're gonna see this situation in US dollar moving lower when this correction is done. So I'm looking for a couple of weeks to 1 or 2 months this to actually actualize in some type of a corrective pattern, and then I think this will create conditions for dollar to move substantially lower, which will also create conditions for when this mess clears out, for the risk assets to go and start moving rapidly higher. So if we look on a Thomson Reuters commodity index, we track this with our members, and also this has been a nice 5 waves up, and we are moving down towards this B wave. Today, oil price, this is the Brent oil, trades below 75. We had a little bit of small consideration. Yeah, it's a huge break to the downside, as you can see. So I think we're going to continue down to 64. So this is Brent. VTI is around 60, now 76, 77. So it's going to be below 70 on VTI. So this rapidly accelerates to the downside, as you can see. So we're going to have a lower commodity prices, as you can see, as the CPI also backed off from 6.4 to 6. Core move 1/10 on the upside, but that's due to a couple internals. But I think also the next CPI will continue lower because it's a lagging data, and all of this period we have lower commodity prices, which is one of the big components of the CPI, and this keeps going lower, which actually gives us all information about the Fed pause, or even if the situation with banks and liquidity goes haywire, they even might drop a 25 basis point lower. So let's see what is going to happen. We still don't know how deep this banking crisis is, but we definitely saw the whole world was panicking, and it was a flight to safety this couple of days. So let's see what the next couple of days will bring. So let me also show you that a Bitcoin. So Bitcoin, this was for our members, the wave count we tracked. So we looked for the support levels here around 19, 18K. Of course, everybody, I think, which tracks cryptos knows what happened afterwards. So we had a huge move on the upside from 19K, 19,200 to almost 26K. I think we are in a little bit of a consolidation. So also Bitcoin is giving us a warning that we might be in a situation when rates are going to pause, or the liquidity is going to come back, because for now it looks really bullish on the upside. Even if we go ABC on the upside, it's between 34 and 40K. A more liquidity, more pause, which I think is going to happen, will give even more bullish outlook to Bitcoin. So we're going to follow this. So if the Bitcoin is one of the, I will say, indicator of liquidity, because I think it is, crypto assets doesn't move up when you don't have any hint of a liquidity coming back, and technically this is a pretty bullish structure, at least for a couple of months. So I'm going to stay bullish. I'm looking for a pullback and a continuation on the upside. So to conclude all of this, I think we're going to stay maybe 125 basis points hike, and that's debatable in this situation. But all what we see is the precipice of liquidity coming back yields staying at the same or going lower, and actually risk on assets moving on the upside. So that's my take, guys, for now.
Nice. Nice. Well done, Alex. Well done, Alex. Snap your camera back on, and
Okay.
yep. And we'll let's take a look here just on the open. As Alex said, the big sector weakness today is, believe it or not, is focused in energy. So if we just pull this over, isn't that unbelievable?
Crude is down 4.25% this morning to 68.30, West Texas Intermediate.
Whoa.
So big
Absolutely
move, big
smoked.
move off. WTI at 68.25 right now.
Yeah. So here's so crude. Where's my crude? Yeah, 68.77, down 3.5%. I was looking at copper as well, Terry. I don't see much. I'm trying, and I was working several, trying to get bullish here, trying to remain bullish. There's not a lot of constructive stuff here in the copper market. So we might have to go back and revisit this. So we just mentioned crude oil's coming off.
You got over, this got crossover in there, overlap.
Yeah,
so
that's a mess.
Can't have overlap in a wave 3.
Nope. This isn't. Again, this is another challenging wave count on crude oil. You could look at this a few different ways, but at this point, it's really hard to say that is not a continuation triangle. A, B, C, perhaps X. And Alex, and Terry, this is your former industry and your real job. Not that this isn't a real job, but you know what I mean. From a seasonality point of view, crude's coming into a typically oversupplied area. Is there any reason we shouldn't go down and test the 62 level here?
From a technical perspective, no. From the fundamentals, the inventories in the U.S. are back inside the 5-year average band now. They did accelerate a little bit earlier than typical.
Mm-hmm.
And maybe it's forecasted gasoline demand in the U.S. is down due to all this advent of new electric vehicles. So it's possible that there would be a short-term oversupply situation in crude. We're certainly not running out of it right now. So
that's interesting. And again, you just look at the move, and it's always tricky when you're doing continuous contracts and rollovers, and it's always hard to do longer term futures quoting. But there's no reason we're only at 23% retracement from the 2020 low, so 60s are okay, and then we'll see how much lower we go. And then as we look on the open here, XLE is the weakest sector on the open. Sure glad we cut that position yesterday. It was down 4.5, and now it's only down 3.5. But energy leading it, materials, energy, financials, industrials, and transports. Transports continue to be weak, and real estate utilities holding up there pretty well. Where's XLK? Down 0.82. Still hanging in there fairly well. I just want to look at tech before we sign off and just, is there a reason to be abandoning the bullish counts that we have? So let's take a look at the NASDAQ, down 0.6 right now. So it's interesting. This is a short-term little 15-minute. Again, I'm just trying to make the case from March 13th that we have an impulsive, I guess it would be a diagonal off the low, ABC down in 2. I'm certainly not married to this count, but we're continuing to see relative strength there in tech. Semis have been obviously the very bright spot within technology, and these guys have just been very sideways since February 2nd, Groundhog's Day, my birthday, and we shall see where this guy goes. So eyes wide open, yields getting smoked again, 3.47%. At some point, I wanted yields to drop. Now I kind of want them to stop dropping. If we could start finding some support to 3.3, 3.2, get a little confidence back in this market, tech can going back, and growth can start going back to what it needs to do, and we can go to work on our shopping list. So trade analysis, we roll with option portfolio. We're doing more option hedges as the market is sideways to down. We hold longer-term stock portfolios in stocks that are outperforming their respective sub-industry, industry groups, sectors and their benchmarks. But right now we're doing a little bit more hedging because the market's moving down. We have some shorts on, and it's definitely a two-way market. So good show. Check us out, Trade
Yeah,
Analysis.
don't forget to mention our stock swing desk, which is on a shorter to midterm basis. So we have that as well.
Yep. Exactly. Yeah, I was saying that. Yep. Building longer term stock portfolio positions in the stock swing desk. What do you think is our standout besides AMD? And AMD's up today. Isn't that awesome? Look at that. Chips just look like they want to go. AMD trying to break out in a down day. Another one
Axon was another good industrial play that's we're up 21% in that one.
Yeah, Lattice Semiconductor trying to get through. AXON has been a really, really fun one. We gotta be cognizant of this one, Terry. I really want AXON to hold the 210 area. I think we trail stop up. I think we move it into 207.
We've already moved the stop up to 199. We protected we got locked in profits on this one. So
sorry, I wasn't sharing my screen.
Continue to advance.
Sorry, guys, I wasn't sharing my screen. Sorry. Here's AXON. We moved the stop up to 199. I'd really like to see it stay above 207. And sorry, I wasn't sharing my screen. AMD up. These chips are just, if we could just get some clarity on the financials, real estate and XLF, these chips are ready to go. AMD, look at AMAT ready to go. Lattice Semiconductor has already gone. ASML, we were early on that one, trying to watch this pullback. That's getting interesting in ASML. And of course, NVIDIA, longer term, we shall see. So looks good. All right, guys, we're going to put a wrap on it. Head over to the members area. Badur, I was kind of watching your evolution of comments here. It was pretty funny, actually. You were saying over on my channel, if it was a broken wing butterfly will be better, whatever. You can do a broken wing or unbalanced. He says, Todd is always bullish. Rest of the TAT must build a case of bearish scenarios. No, I'm not always bullish. I'm always 2A in the market, right? I'm always 2A in the market, but it kind of cracks me up, when people say you're always bullish. Well, usually it pays to be bullish because the market typically tends to go up. And if not,
the long-term trend of the market's to the upside.
Exactly. And if the I'll show you a longer term, see if I can pull this up quick. And if not, central bank and the administration and Congress will step in to right the ship. It's you look at longer term charts. Yes, I think you could tell that I'm cautious. I'm certainly looking at the blue and yellow count. But if you look at longer term of where we're going, there's not a lot of evidence to suggest that this might be a long-term significant top. You look at Apple, and we're going to wrap this up here. But let me just finish with this one. Look at Apple longer term, right here. And I'll just kind of hide this a little bit. Look at Apple longer term. Can you see the new bear market emerging from this? I can't. You must be better than I am. So I just kind of laugh when people say you're always bullish. Yeah, I am always bullish because generally I'm constructive on human productive output. Now that we're going across borders, reaching across borders, technological deflation is there. Companies are running more efficiently. Look at Meta, cutting people, stocks going up. We're embracing technology, and as interest rates get under control, you're going to continue to see that rotation into growth. So no, I'm not always bullish. I've got hedges on in the downside. I've got a significant amount of cash on my wealth management business on the sidelines, waiting to deploy. We've had short hedges on. So no, I'm not always bullish and not bearish. I'm a two-way trader. Trying to deploy capital efficiently and smartly. for what the market holds today and likely, into the future. And that's all you can do is assess the now and do your best to have your current positioning reflect the rewards in the current market as well as the risks. That's why I love Elliott Wave. It's not an analytical. You're killing me with that mic. It's not an analytical.
You asked Alex to get that super loud mic.
I know. I'm so sorry. I be careful what you wish for, right? We couldn't hear him before. Now I can hear his heartbeat.
Now we can hear a mouse fart. So
I can hear his heart beating through the microphone.
I think James Bond is always on extreme.
Whatever you do, Alex, do not fart on this live stream.
I will not, I promise.
All right, we're going to wrap it there, guys.
All right.
A lot of fun. Alex, Terry,
week.
Great job. Check us out at Trade Analysis. If not, you have to wait till next week. Good job, guys. Thanks so much.
See you guys.
All right.
Bye-bye.
Hi, I'm Todd Gordon, and I can't believe it. It's been 8 years since I launched this business, and what a ride it's been. Welcome to TradingAnalysis.com. We're one of the leading education, analysis, and trading alert companies on the internet. We are a team of devoted professionals who trade our capital in a live, transparent manner to show you what the life of a trader is actually like. Keep in mind, this is an industry filled with smoke and mirrors, with cheap sales and marketing tricks, so it's been my mission to run an above-board, transparent, and brutally honest operation to serve our clients in the best way we know how to prepare them for life in the markets. Every single day, we offer video and written analysis for the major trading markets, including stocks, stock options, cryptocurrencies, and Forex markets. We offer live and clear-cut and actionable trade alerts in these markets, and they're sent straight to your cell phone and posted in the members area on Trading Analysis. Once the trade is out, we certainly don't leave you hanging. We follow up on every trade, whether it's a winner or loser, and we'll conduct post-trade forensic to show you what went right, what went wrong, so you learn. And very soon, I'm going to be sharing my real-life seven-figure portfolio with our members who prefer the longer-term investment time frames with some medium-term trading and option strategies mixed in as well. So head on over to TradingAnalysis.com after this show is over.